every meeting, and his health expert, Bob Williams, is typically there as well. So I happen to know that he is very active in the monthly management of the drug prescription costs associated with the plan. Section 2 prohibits a PBM or third-party payer from charging or causing a patient to pay a copayment that exceeds the total reimbursement paid by the pharmacy. We're trying to get to the crux of the matter. We want the funds to go into the plan or to the benefit of the patient. There's 3 reporting requirements set up in this legislation. The first one requires that each drug manufacturer quarterly submit a report to the Commissioner of Insurance with the current wholesale acquisition costs for the prescription drugs sold in the state by that manufacturer. The other report comes from the PBM. They must file a report with the Commissioner, and it must contain the rebates, the fees, and any other payments collected from each drug manufacturer. The third report requires each health insurer to file a report with the Commissioner. The report must contain the names of the 25 most frequently prescribed drugs and the 25 prescription drugs dispensed with the highest dollar amount. Commissioner of Insurance will develop a website to publish the information required under these chapters. This is full transparency. These reports, we want them to be available to everyone interested. In Section 8, this section prohibits the PBMs from interfering with the patient's right to choose the patient's pharmacy of choice. So this is keeping intact with the relationship of the individual and their local pharmacy and who they have a relationship with. If you like your local pharmacist, you're going to like this portion of the bill. This prohibits them from being cut out of the process by the PBM. Section 11 creates a new law that requires the PBMs to identify any ownership affiliation with any pharmacy. We want to know if the PBM's fiduciary relationship is to the plan, which ultimately will benefit the patient. This legislation also prohibits spread pricing. The PBM shall pay 3 things: the prescription cost of the medication, the dispensing fee to the pharmacist, and the PBM fee as disclosed, with no hidden payments. A PBM contract with a health plan must specify all forms of revenue to be paid to the PBM and a statement that the spread pricing is not allowed. We had many meetings this summer on this issue, and these are some great things that came as a result of the meetings. This is good for transparency. We'll have a better understanding of that the money in the plan will go towards the benefit of the plan and the patient. Are there any questions?
Mr. Chairman, I have one, if you don't mind. Is there any numbers or documentation of other states' prescription premiums being lower with the insurance department ahead of PBMs other than the pharmacy board? And is there anybody in the insurance department that could answer that?
I don't imagine they have a poll of all 50 states drug pricing.
I guess what I'm getting at is if we made these changes and the pharmacy board's still in charge, would that lower it, or I guess is my question.
Well, the reason we've made this is all about transparency. I don't know that it's going to affect the pricing. However, what we are going to find out in the transparency is the cost of the drugs. And we're going to mandate that there's no rebates to the PBMs, that the money would go back into the plan and benefit the patient. And from knowing that Insurance Commissioner Cheney attends the monthly meetings of the state health plan and his knowledge on the pharmaceutical part of the plan, and also his assistant in office that attends the monthly meetings, and also from his being in the study committee this summer, I'm convinced that he will do a good job with it.
Thank you, Mr. Chairman, for answering.
Hey, is there, we need to adopt the committee substitute. Is there a motion for that?
Yes, I make a motion. I make a motion that we adopt the committee sub.
Okay, all in favor, say aye. Any opposed? A committee substitute is adopted. Now we move motion title sufficient.
Mr. Chairman, I make a motion title sufficient. Oh, we got a question.
Okay, we're on the committee substitute.
Right. But going to what you said the insurance commissioner does want this?
Yes.
Okay. I'm getting emails and texts from, you're saying that it would be good for the local pharmacists, independent pharmacists, but I'm getting emails and texts saying they don't want it.
Yep.
So, I'm confused. a little.
Okay, I think I got the same email you did. This comes from the bill we had, y'all might remember a bill we had last year. And there were a lot of people who put their name on the bill and took the name off of it. This comes from study committee during the summer. This comes from input. It's my understanding the House has had an input on this as well. There were conversations. Maybe what you're hearing is that your pharmacist is not getting 100% of what he or she wants. I think they're very happy with the transparency. I think they're very happy with the fact that a PBM cannot cut them out now, that they must dispense, you offer the same benefits in drug reduction costs to them as they would maybe their selected mail order pharmacy, as an example. And but if you have concerns about, the concern I got was that of Commissioner Cheney being in charge of the program, and we're doing what it's my understanding 48 other states have done. And I have full confidence in Commissioner Cheney being able to handle it.
One other question, will this interfere with the ongoing investigation that Board of Pharmacy is doing on PBMs right now?
I know there is an audit going on. Is that what you're referring to on one of the PBMs?
Yes, sir.
No, it's my understanding from I handle their budget. I'm on the appropriation subcommittee that handles their budget. It's my understanding they're expecting to have that completed soon. Okay, motion was title sufficient, do pass, committee substitute. All in favor, say aye.
Aye.
Any opposed?
No.
Hey, let's have a vote. Let's show total. All in favor, say aye. Raise your hand, excuse me. All in favor, raise your hand, please. Any opposed? Okay, that bill will not be reported. Okay, we'll go to item Senate Bill 2740, insurance authorized counties, municipalities, school districts, and other political subdivisions to pool their risk. That's Senator Rhodes.
Thank you, Mr. Chairman. Senate Bill 2740 basically just gives the county, municipalities, school districts, and other districts and junior colleges the ability to pool their property insurance together in hopes that they could seek rates that would be better for them. Right now, that's prohibited, and so that's pretty much it just gives them that opportunity to pool their risk.
Are there any questions? Dr. Kirby?
You wish I'd stayed at the other meeting this morning.
Glad to have you.
Well, thank you. I know it allows them to pull it, but I have problems with it. And the reason being when the counties, municipalities, well, especially school district, you have the hometown insurance people that support those schools. I mean, way more than some out-of-state company would if you were to pool it and put it in with some other. In other words, they could care less whether East Rankin Academy ever wins another state championship. Congratulations on that. Or not state champ, overall championship. And these people that are local not only support the schools in every way, including financially. So are they really better off if they pool these things? And even if they get a little bit less premium, because they're going to get a whole lot less contributions. As an example, when they were talking about doing this with the universities, I had 3 different insurance agencies call me years ago that said, we all 3 give $50,000 a year to a major university. Yes, they do write part of, they did write part of their insurance and still do, some of them. But what I'm saying is you're really cutting out the hometown people. Now, I know this doesn't say they have to do it. Am I correct? It just gives them the authority to do it. I'm not sure it's a good idea, Mr. Chairman. That's just me.
Is there a question?
I have one.
Mr. Kirby, you made a statement. Do you have a question, Senator Rhodes?
No question.
Okay.
No, thank you, Mr. Chairman.
Senator Leno?
I'm trying to figure out how to phrase this as a question, Mr. Chair.
I was too.
But wouldn't you agree that this bill was, or it still provides home rule, meaning that the jurisdictions, the local jurisdictions can make that decision or not? You may, or would you agree with that?
Yes.
Okay, thank you. You may not be aware of this, this issue specifically, but I know that this bill originated out of a very dire need for some of the jurisdictions on the Gulf Coast who are trying to find windstorm coverage. And those risks are extremely high dollar risks for insurance pools, including those that are available through the different associations to the state, whether it be the supervisors or the school boards or this, that, or the other. There is a very, there are very few insurance companies that are willing to take on that risk. So this bill actually came up because there is an opportunity to aggregate those higher risk policies or those higher risk coverages into a pool that we could then go to a larger market and try to provide coverage at a lower cost for our local jurisdictions. This would give us a vehicle, especially on the Gulf Coast, to pool those wind pool or windstorm loss policies and go to market to be able to do that. So this bill is very much needed. I understand that some of the concerns that Senator Kirby has made out, but it does have that home rule flavor to it. And it may not be the best for everyone, but I think everyone will agree that if you're able to take and I'm asking you if you would agree, if you were able to take that windstorm risk out of those statewide plans that we have on the Gulf Coast, and you were able to aggregate those, it would lower the overall risk for those other plans, those other statewide plans for the individual associations. And hopefully it would provide cost savings for the rest of the state. So that's the real genesis for this bill, and it's a great bill. But would you agree with me with the comments that I just made?
Yes.
Thank you, Mr. Chairman.
Senator McClendon?
Thank you, Mr. Chairman. Senator Rhodes, what if a municipality wants to join, but that group won't let them due to their loss ratio? What happens then?
Imagine they would just go back to their fallback position. They wouldn't be able to participate in the group pool.
So aren't we then selecting the best apples to go with the best apple bunch and throwing the worst ones to the coal sack? I mean, is that really fair?
Senator Kirby?
Thank you, Mr. Chairman. Look, it does say may, and I know the bill probably needs to be reported out. And I do understand and I do realize, because I have some property on the coast has unique problems or special problems that the rest of the state doesn't have. And anything that would help the coast area, their schools and their municipalities and any other political subdivision, I'm all for helping them. And it does say may, and I do agree also that you're going to have a hard time pooling because of the fact of the coast. I mean, why would someone in Tupelo want to be paying the same type rates as someone on the coast? So it's going to be very difficult, but I'm all for helping. And since it does say may, I'll be happy to support the bill.
Okay, just to reiterate it, it does say may, and it also does not just deal with school districts. So if the county and the municipality and the school district, specifically on the coast, could find benefits from economies of scale of pooling together, that it possibly would help them. I mean, it's not going to force anyone to do this. Any additional questions?
Mr. Chairman, if I may, I don't know if if you want to do it now or if we do it on the floor, but if we work on this and offer a repealer, because this is something that, and I asked this question in one of the meetings we had this summer. We're just talking about property insurance here. I mean, wouldn't it benefit everyone if we also had health insurance in this plan? But anyway, I would hope if this does go further and we put a repealer, at least to see how this is going and how it would affect others. And that's all I got.
All right, Senator Rhodes, your motion.
Title sufficient do pass.
All right, the motion is title sufficient do pass. All in favor, please say aye.
Aye.
Any opposed? That bill will be reported. Senate Bill 2786, lender-placed insurance. Senator Kirby, you get the mic again.
Like I said, I bet you wish I was in the other meeting. But anyway, thank you, Mr. Chairman. This is exactly what it says, lender-placed insurance on real property. There's been some other states that have done this. It's NAIC Model Act that's supported by the insurance commissioner. The good part is, like I say, that this bill really is for consumer protection more than anything else. Now, if I were Terry Brown, I'd say title sufficient do pass, but I'm not. I'm going to explain it. So a little bit of it anyway. Again, it's lender-placed insurance dealing with real property. So you're talking about insurance on mortgage, real property, your homes, manufactured homes, modular units, those type things. And it'll become effective no earlier than the date of the lapse of the insurance. In other words, if you have insurance, you don't pay it, it cancels. The lender wants to make sure they're protected, and it can't be effective until the day, the actual cancellation of the other policy. And it should be based on the replacement cost of the property. So I think it says even in the bill that whatever the last amount that they had insurance on it, if you had $100,000 on a home, the policy cancels, then the lender would place $100,000 policy on it just as you had before. If there's any excess, in other words, you show proof of insurance, come and show proof of insurance, then this policy would be canceled. Your policy would go into effect, and any excess premium would be returned to you. The insurance would actually be added to the mortgage in case of lender-placed insurance. So the good part about this, like I say, it's NAIC Model Act. It has penalties in it. It's under the Department of Insurance. Bills have to, rate structure and premiums and all have to be filed with the Department of Insurance and approved by the Department of Insurance to make sure that they're not charging too much. And I think that's a great idea. There are penalties now in this, and I like that. The section requires that no later than April 1st of each year, each insurer with at least $100,000 in direct written premium, has to file and can have penalties. And the penalties, let's see, payment of penalty of not more than $1,000 per violation, not to exceed the aggregate penalty of $100,000. But if it's a fragrant type and very conscious disregard of the act, then the penalty suddenly changes. And the commissioner then can charge up to $25,000 and up to $250,000. And of course, the commissioner also has the authority to suspend their license. That pretty much explains the bill. It's no questions. I move title sufficient do pass.
Senator Delano for a question.
Thank you. I appreciate it, Mr. Chairman. Senator Kirby, how is this different than forced placement policies that banks are able to do at this time?
How are they doing it now? You say? Oh,
Forced
I
placement.
didn't say that now. I should have said. Also, they're doing forced place insurance now, but it's not under the regulations that it should be, and there are no penalties like it should be. So this is really making sure that forced place insurance is adequately charged and that it's a good policy. Like I said, any forced place coverage has to be approved now with this bill by the Department of Insurance.
Okay.
and not currently.
So, but this bill, and I want to try to understand because I really am not aware of the differences between or how banks do it and if there are any that do it different than others or if there's a standardized process by which they do it.
It is. And of course, there's commissions on it now. There are people, actually, this is no commission.
Okay. So if I have a commercial property, for example, and if I have a commercial property and for whatever reason, I do not make my premiums for my insurance and the bank has sent a letter of cancellation from my policy or from my insurance company. The way that I kind of understand it, and I just haven't been in this position, thankfully, but the way that I understand it right now is that banks have they go out and they purchase a pool of risk for their forced placement for their loans that are outstanding, and they're able to get a cheaper premium for those particular loans. But it's a pool. It's over an umbrella of their loans that are outstanding. Does this bill say that a bank would be able to take, for example, that shopping center, that single asset, and go and get a policy for that single asset and then charge the borrower for the premiums that are required to satisfy that?
Yes, what this does, if you had a shopping center and the policy canceled, this policy, the unforced place would be just on that shopping center. And it would be for the amount of insurance that you had on it. And it has to be, in other words, to be properly insured and properly charged, according to the rates that are filed with the commissioner. Does that answer your question?
Well, I guess it does, but it's going to be, I don't think there's any way that I can support this bill because of the windstorm issues that we're having on the coast. There are many commercial properties that are unable to find any coverage at any dollar amount on the Gulf Coast. The only way they've been able to do it is if they were able to find someone who could aggregate that risk. And much like what we were just talking about in the previous bill, they would have to aggregate that risk with other properties through an insurance provider to get a much larger policy.
But so many of those, like you're talking about, what they have is, if, let's say you have $1 million shopping center and you owe $500,000 and it's destroyed, it pays off the loan. You get nothing. This makes sure that you would get paid as well.
Right, but the problem that we have on the coast is that if we go out and try to get insurance in the free market or in the open market right now, and it's unavailable, or it's at a cost that is 5 times, 6 times of what it was in 2022, then there are properties that just don't cash flow. So there are owners that have to say, I have to go naked. So then the bank comes in with a forced placement that covers just the amount of that loan. What you're saying here is that the bank is going to be able to go get a policy for that particular property for replacement cost, which is they're going to be in the same situation that the landowner was in. So that $40,000 premium is going to be paid by the bank, and then the bank is going to put it onto the landowner on that deed of trust, or they'll put a lien on it. And that's going to cause all kinds of havoc on the Gulf Coast. I understand the issues that the banks have. It's just putting a magnifying glass on the problems that we have with the markets right now and how tight they are. But this is going to put a lot of people on the Gulf Coast specifically in default almost immediately because of the lack or the inability to find coverage on the Gulf Coast.
Yeah, I understand what you're saying. So you're going maybe 50% insured, and all at once they're saying, no, we're going to do replacement costs, whatever it is. I'm not.
It's a horrible situation for anyone to be in, but especially on the commercial markets, the way that we've seen it. And, you know, I'm telling everybody in this room, these stories that we hear. And if I've got this wrong, I want to know about it. But this particular bill is a significant change in lending for the Gulf Coast, especially in the Gulf Coast areas. And I think that this could be extremely bad for for business owners and homeowners, frankly, but I'm thinking of it specifically for the commercial market. This could be incredibly detrimental for the Gulf Coast.
You answer this if you would, aren't most all the properties, as far as property insurance, wind, hail, aren't those with non-standard companies?
Surplus lines, is that what you're asking?
Well, I'm not sure. I'll have to ask the commissioner or someone from the commission. I'm not sure this applies to that because they have no jurisdiction over non-standard market.
I'm not, it's your bill. I really don't know, but I do know that there are many commercial brokers or many commercial insurance providers that have contacted me and said that they've got problems finding coverage, especially between the $2 million to about $10 million in insured value, that they're just unable to write that policy or replacement. And I know, the chairman and I are both in commercial real estate. We've had many transactions that have not been able to close because the buyers of the properties have been unable, not unwilling, but unable to find a premium or a coverage that they could replace that, or that they could get on that particular piece of property. So I understand, Mr. Chairman, but I'm going to have to vote against your bill.
As I said a while ago, the coast is unique. It's different from the rest of the state. This would be wonderful the rest of the state. If all the properties there, which the property I have, I had to go non-standard market because there wasn't any.
I understand.
And so I don't know that it would affect. Mr. Chairman, may I ask that someone, the commission, would this affect the coast as far as, since they have non-standard, or maybe this needs to be amended in some way for non-standard?
Well, it's also important to note that we're talking about lender placed. So are you saying that there are banks on the Mississippi Gulf Coast on that $2 million shopping center that would make a loan and not require there to be insurance on it?
No. They would make the loan. Let's say the loan is in place and existing today, and you've had coverage and you've been able to provide coverage throughout the life of the loan.
Right.
But then you go for a renewal, let's say in March of, this week, you go and try to get a renewal, and you find out that the carrier that you have your coverage with today is not going to renew that policy. Well, then they've got to go out and find somebody else, someone else to do it. And it's either unavailable, or in a lot of cases, it's 2 to 3 times the premium that you were previously paying. So the owner of the property has to say, what can I do? Do I go naked or what? And banks are in the position where they've had to use that umbrella policy to provide that forced coverage. They still charge the property owner an amount for that forced coverage.
Right.
But instead of it being at replacement cost, it's just the cost or the value of the loan, which is a lot of risk for a property owner. But if your premium goes up 2 to 3 times what the previous year was, as you know, that's a significant increase. That is something that they can't bear. So it's just an unfortunate. And we know that this is and hopefully it's a short-term problem, that the markets free up a little bit and that there's more but there's no residual market for these types of coverages either, because the wind pool won't cover anything that's over $1 million or so in coverage. I know there's some discussions about them changing that. But for right now, we're just in a dire straight situation, and we certainly hope that the world financial markets loosen up a little bit. And I hope that I'm wrong about this, Mr. Chairman, but I think I've wasted enough time in this committee to, where I'm going to vote on it though, and the reason why.
Mr. Chairman, if we can ask the Department of Insurance, I think David Browning is very familiar with this. How would it affect them? Would that be okay, Mr. Chairman?
Yes.
know, this bill doesn't change. How, rates, there was rate model. That's it. This was really kind of service that handled it. This doesn't change what you're talking about. Look, we worked on this for 12 years at the NEIC. Everyone in the world. This is so, it's out there for protection of consumers. You know, some of what you're talking about. That's great. This provides out the rate. This is nothing changed.
It wouldn't change, as far as the non-standard markets that write most of, all of that property down there, it wouldn't change anything.
So is it right now forced placement? And I'm, again, I want to be corrected on this if I'm wrong, because I need to understand this better. But forced placement, it's my understanding that the bank would only insure it for the loan amount. And that was so it was protecting the bank. It certainly wasn't protecting the equity or the ownership. It was solely to satisfy the loan amount. But what I understand here is that that premium would be based on a replacement cost of the property. Is that new language?
It does say replacement cost in it. It does. But it also says, or the last amount of insurance you had. So I think maybe if we did an amendment that simply said excluding non-standard, non-admitted carriers, that would pretty much take care of it, wouldn't it?
I've stated my concern. I know this bill, the chairman would like to see this go through, and I don't want to stand in the way of it. I've just addressed my concerns, and I would like to see it as it works through, or see those issues addressed as we work through the process. That's all. I appreciate your time.
Chairman Kirby, for a motion?
Title sufficient, do pass.
Okay, the motion is title sufficient, do pass. All in favor, say aye.
Aye.
Any opposed?
One.
Okay, Senator Glenn, you move your rise and report? We stand adjourned.